We'll see the relationship between strategy and financial objectives. Okay, see, this is the overview of a strategy process. The company starts with its mission objectives, it creates a SWOT, then it finds out to achieve the mission and objective, what are the various options it has, then it evaluates which is the right option, they implement their objective, periodically they check whether that strategy is working or not, and finally they keep evaluating it. Okay, so where does a financial manager come here? See, the financial manager is the person who fixes the objectives for the company, like what should be the ROCE, what can be ideally the ROCE, what can be the debt equity ratio for the company. These are the things. Then he evaluates the investment decisions. Assume CEO says 3 4 investment opportunities to build a factory, to export or to import something. Financial manager evaluates the decisions such as which project to invest, okay, and how this will affect the dividend policy of the company, and what is the source of finance for this decision. Okay, so he thinks in terms of these decisions. Even though this entire strategy is taken care by of the CEO, the financial manager has to support the CEO in terms of financial ideas. Okay, so he will also consider whether the project which are like suggested by the CEO is okay or not. Okay, so he will tell his part of the view. So finance is not something which is separate from the strategy, it's part of the strategy. This will help you in answering questions at the SBL paper. So what are the financial objectives of a company? So usually these are the objectives: profit maximization, wealth maximization, gearing ratio, profit retention, and operating profitability or profitability ratios. We'll start from profit maximization. So the objective of an organization is to maximize profit. That's a nice thing. Profit maximizing is about increasing the profit of a company. How do we know whether the company has increased their profit? It can be measured through EPS, earnings per share. This is a nice concept when the owner and the manager are same person. Okay, if not, then profit maximization is not a good technique. Why? Because profit maximization is a technique where the profit can be manipulated by the manager and submitted to the owner. Okay, so the manager can cheat or manipulate the EPS. Okay, and after manipulating the EPS he might give it to the owner. So over a period of time what happens is the manager keeps on manipulating the EPS and the owner believes that the EPS number is to be true. So profit maximization is not a good idea at a corporate level. So profits can be manipulated. So profit maximization is not such a good method to track shareholders' wealth. Thus, profit maximization is a flawed financial objective. So we'll move on to the wealth maximization. The objective of an organization is to maximize wealth. Maximizing wealth maximization is about increasing the value of the company, not the profit of the company. But the question arises, what is the value? What is the value that we are going to increase? Value can be book value. Book value can be net assets. This you will learn in detail in business valuation chapter. But in terms of to understand now, book value is the stated value in your balance sheet. So book value is the balance sheet value. Usually balance sheet values are historical values. Okay, they are not real today's value. Or you can measure the wealth of a company or the value of a company through market value. What's market value? Through market capitalization you can measure it. So multiply the total number of shares of a company into the current market price of the share, you will get the market capitalization. With that you can find out the wealth of a company. Wealth maximization can also be liquidation value, the value that is realized by selling all the assets. Of course, companies are not trying to sell their assets. And there are other ways to measure wealth maximization. So one formula is a very important formula from your exam point of view is total shareholders return. That is the price after 1 year, the price of today plus the dividend that you'll get within this year divided by the price at which you have bought. Assume that you have bought a share, okay, you have bought a share, the price of that share is 100 rupees, okay, that is P0. The share price has become 120 rupees in a 1 year time, plus you got a dividend of 10 rupees, so total comes to 30 rupees divided by 100, so that gives you 0.3 or 30% profit. Okay, so that is called as shareholders return. We can also measure the company's wealth maximization through total shareholders return also. So we'll have a quiz, you can read it by yourself, you can pause the video and see it. So we'll discuss which of the following statements are correct. Maximizing market share is an example of financial objective. No, market share is something which is related to the concept of marketing. Okay, market share is related to marketing. This is not correct. Shareholder wealth maximization is a primary financial objective of a listed company. Yes, financial objectives should be quantitative so that their achievements can be measured really good. Okay, for example, ROCE should be how much we want to achieve, 20% ROCE. This is quantified, so the answer should be 2 and 3 are correct. The answer should be C. So we got the answer. This is a 2-mark question. We have another question. You can pause the video. Which of the following is a sign that a company is failing to maximize shareholder wealth? The key element here is the word failing. Which of the following is not maximizing shareholder wealth? Management has a challenging performance bonuses. If the bonus is given for challenging work, it maximizes the shareholder wealth. So this should not be the answer. Investment decisions are evaluated on the basis of NPV. Further, if we read on other chapters, you will find out that NPV is a best method to evaluate investment decisions. So this is a good, this is increases the value of the company, so we'll strike off that. The company has not diversified its operations. Diversifying your operations and maximizing shareholder wealth doesn't have any relationship at all, so that's not answer. Financing of the company is done by equity finance alone. Usually financing has to be done with debit plus equity, okay, because debt is very cheap and equity is very costly, so you have to do with both if possible. So the answer should be D. The answer is D. So which is failing to maximize shareholder wealth is D. So we'll discuss in this slide about the various stakeholders and their financial objectives. So here we have internal stakeholder, connected, and external stakeholder. Within internal we have employee. Employees want salary, managers want bonus and salary, directors want salary, bonus and ESOP, shareholders want share price, profit growth and dividends, debt holders want interest and principal, suppliers want prompt payment of bills, government wants their tax and following their regulations. So this is where the financial manager has to play a kind of a role where he wants to satisfy all the stakeholders and still make everyone happy.